there in combination with where valuations are, where yields are going to perhaps, what does that net out to in terms of a market outlook for you, what investors should emphasize here?
Yeah, no, I think it nets out to, we're not going to really see the strongest returns from the S&P 500 this year, unlike pretty much every other year over the last decade. So I think investors need to get used to the idea that U.S. large cap stocks don't just go straight up forever. I think what these indicators are all telling us in concert is that sentiment has grown, fairly euphoric on stocks. We don't hear too many bears out there. We're also seeing a point at which the market has essentially priced in a lot of the good news that we're likely to see this year. So, don't get me wrong. I think this is going to be a great year for the economy. I think it's going to be a great year for S&P earnings growth. We've got something close to 20% penciled in for corporate profits growth. But last year, the market saw massive multiple expansion in anticipation of that growth. So I think our view is that there are probably other spots where you can get better bang for your buck, namely, value stocks, small caps. We still don't think that those areas of leadership are over. So that's where we would focus our portfolio concentration at this point.
Yeah, I was going to just say, this rotation, this kind of exit from large cap growth, which dominates the S&P, and entry into more cyclical and value areas, it's really, at least in a subtle way and now in an obvious way, been going on for a few months right now. So what would you be looking for in terms of knowing when we have sort of priced in this outlook, when those sectors have become more fully valued?
Yeah, it's a great question. When do you get out of this value trade? And that's what we hear the most. So I think there are three things you want to look at. One is valuation, and cheap stocks are still really, really cheap relative to expensive stocks. The way we just measure that is by the dispersion between high and low PE stocks. It's still at almost record wide levels. So I think we would want to see that snap back a little bit more. The second thing I would watch is positioning. And I think what's been interesting is that even though we all kind of know that this year is going to be pretty different from last year for a whole host of reasons, new administration, reopening versus shutdown, et cetera, investors haven't really changed their positioning that aggressively. So when we track hedge fund holdings and institutional manager holdings, they're still very embedded in this growth, tech overweight positioning. They've only started to leg into energy, financial. So I think that's another factor to watch, is when that selling pressure is over and when you see more buying, when that buying pressure is over and when you see more selling pressure. And then the third thing I would watch is the economy. And I think here what I worry about is that as we get further into the year, if the economy starts to recover and look like it's on better ground, we might start to hear some of the negative rumblings from policymakers around potential tapering, tax hikes or reversal in the tax cuts that we saw a couple of years ago. So some of those negative headlines might weigh on the idea that this cyclical recovery is going to go on forever. And I think those are the factors to watch. Are kind of those three factors are really important to get a gauge of how long we have to go here. I will tell you this, typically in an economic recovery coming out of a recession, value outperforms growth for at least a year. So I think that, the idea that we've had 6 months of great performance doesn't necessarily make me too worried about this continuing.
Shepard Smith here. Thanks for watching CNBC on YouTube.